Welcome guys, it's Chris, JC Trading. Welcome back. Today we're going to be looking at the inverse fair value gap strategy and how we trade it. It probably differs a little bit from other people, but we've had great success with it and I thought I'd share with you how we trade it. So there's a couple of things that we need to look at. The first thing is all trades start with liquidity and they end with liquidity. If you understand liquidity, you have the keys to the kingdom. Fact. Second thing, a single fair value gap, ideally a 1 minute fair value gap. Thirdly, a minimum of a 1-to-1 R trade. So let's hop over onto the charts and talk about liquidity firstly and what a fair value gap is. So a fair value gap, for those that aren't aware, is an imbalance between three candles. It has to be three candles, candle 1, 2 and 3. The gap between candle 1 and candle 3 is your fair value gap. So when we look at the charts down here, let's go over to, there's a singular one here. Look, this was a silver bullet entry from earlier on. It's not an inverse, but I leave the markings up on the chart. So excuse that for the purpose of this video. So what is a fair value gap? Well, we need three candles. Very important. This on my chart you'll see is candle 1 there. Then we have candle 2 there, and we have candle 3. Now the gap between candle 1, that wick, and the wick on candle 3 is the fair value gap. That is how a fair value gap is formed. So now that we know that how a fair value gap is formed, I couldn't talk there for a second. Now we know how a fair value gap is formed. What we now need to look at is the different types. Well, there's bearish and there's bullish. If the market's going down, then we make bearish fair value gaps. If the market's going up, we make bullish fair value gaps. I've got mine in red and green. Obviously you can pick whatever colors you like. So now that we know what a fair value gap is, how it's formed, the number of candles and what it is, we need to talk about liquidity. If you remember, the very first thing on our list is a sweep of liquidity. We will not take a trade unless it's swept liquidity, because trades start with liquidity, they end with liquidity. And it's absolutely critical that you know about liquidity. We go on about it a lot in our Discord server, and we keep going over it again and again because it is so important. It's a cornerstone. So with regards to here, now liquidity are stop losses. If we look at price action here, we are in an uptrend. Hopefully you would all agree with me on that. So when we are in an uptrend, where are most people going to be placing their orders, or what type of orders will they be placing? Well, they're going to be probably placing buys because it's in an uptrend. You'd be pretty mad not to do that. So stop losses are going to be residing underneath these lows. You need to imagine if you had placed an order at any point during this leg up, where would you put your stop loss? And it will more than likely be at one of these lows, because that's an obvious place to put it. What we need is a sweep of one of these areas before we even consider taking a fair value gap or an inversion of a fair value gap. So we need a sweep of liquidity. Liquidity is stop losses, as I said. You've got to think about the markets through the eyes of average Joe. Average Joe is in an uptrend. Average Joe is going to buy where the stop loss is going to go, underneath the higher lows. That's where the liquidity is going to be. So in order for me to take a trade here, for argument's sake, I know that we've got liquidity underneath there. What I would like to see, ideally, sorry, I have to keep peering around my microphone. What I would like to see is a sweep of this area and then an inversion of a fair value gap. It's critical. You have to have a sweep, and you have to be able to identify what sweep happened, what type of liquidity, and obviously where it was. Now, liquidity is a whole subject in itself, and I go on a lot about liquidity in Discord. It will have its own video, but for the purposes of this, there are different types. We've got external, we've got internal, we've got swing, and they all have a different role to play. But ultimately, liquidity is always liquidity. Whether or not it's at the bottom of a swing, whether or not it's in a trend, whether or not it's at the top or bottom of a range, it's all liquidity. It's the same thing. So what we're looking for is a sweep of liquidity. Now, if we go back to our second point on the list, a single fair value gap, what does that mean? Well, I know for a fact, not for a fact, but I'll be very, very surprised, we are not going to get from all the way from here down to here without making several fair value gaps. That's probably not going to work for us. Ideally, what we would like is a sweep. Let's see if we can find one in real time. What we ideally like to see is a sweep of liquidity that only has a singular fair value gap in the leg down. And I probably should have got a screenshot or had something for you here. Let me go back here a little bit. Okay, so let's have a look here. So this is a really good example here. We've got a fair value gap here, there. What we've just seen here happen is obviously we're in an uptrend. We're in an uptrend. Where's average Joe going to be placing their orders? They're going to be placing the orders for buys because we're in an uptrend. Where are they placing the stop losses? Underneath the higher lows, or at any point during these legs, really, to be honest. So when we get a move down like this, what we're actually doing is sweeping liquidity. We're taking liquidity. What we ideally like is a singular fair value gap in the leg that comes down and sweeps liquidity. Ideally, we only want one fair value gap in that entire leg. Ideally, again, it will be a 1 minute. So let's just say hypothetically we've come down here, we've swept liquidity, and we've got a singular 1 minute fair value gap. This is now looking good for a trade because we've come down, we've taken liquidity that was built up here. We've got hypothetically a singular 1 minute, and we're waiting for that to be inverted. So this is now meeting our rules. So if we go back here, we've got a tick for sweep of liquidity. We've got a tick for single fair value gap. What we need now is a minimum of a 1-to-1 R. Now, by that, it goes back to liquidity. Remember I said the trade starts with liquidity and ends with liquidity. So we've started with liquidity because we needed a sweep. We've got a singular fair value gap. Now, what we need to do is work out where our next area of liquidity is. Now, if we look at here, that is our next area of liquidity, just there. So if we put our tool on here, at the close of that candle, there, have we got a 1-to-1 before we get to the next area of liquidity? No, it's a 0.27. So although we got a tick for 0.1, the sweep, a tick for 0.2, the single fair value gap, we haven't got the trifecta. We don't have a 1-to-1. So we would wait for the next trade, and we wait until we get the perfect trifecta. So with regards to entering the trade as well, I'm just going to touch on that. You enter once the fair value gap has been inversed, which would be here in this instance. Now, obviously, we've just ascertained this isn't a valid trade, so we wouldn't have taken this trade. But you enter on the close of that candle, and you wait for the candle to either close below this fair value gap. That then invalidates the trade, and you manually exit. There is no hard stop loss with this strategy. Or you wait for price to get to your break even, which will be the next area of liquidity. And at that point, you can either go break even, you can take partials, you can take all of the profit off the table. The choice is yours. I personally let my trades run, and that's how I generate the higher R gains. I'm prepared to take more break evens and fewer wins, but those wins be higher R's, than I am to take lots of 2R wins, 1R wins, and so on. So are there things that would stop me from entering a trade? So we've got our 3 rules. Obviously, it needs to meet all of these rules. If it meets all of these rules, well, have we got a green light? Yes, in most situations you have. However, if we had an inversion set up, let's just say we've got an inversion set up here. Now, if I were to have equal lows just below it, that wouldn't be a trade I would be prepared to take, because we've got an obvious draw on liquidity underneath where we're going long, and there's every chance that the market would want to go back and take that liquidity before it then takes off. When else wouldn't I want to take a trade? I don't tend to take these trades, obviously, before news, because news can make the market extremely volatile. I don't tend to take them on session changeovers, because session changeovers, again, are extremely volatile. So you do need to be slightly careful with those. Apart from that, there's very few reasons why, as long as it met my rules, that I wouldn't take the trade. So just to recap, we're looking for a sweep of liquidity. That can be any liquidity. We've touched on internal there, but there are other types, as I mentioned. We've got swing and we've got range, internal and external. We go through this, as I say, a lot in the Discord server, because if you understand liquidity, you can use the chart more like a map than a chart. You have a very good idea about where it's gone, where it's going to, and why it's been where it's been, and why it's likely to go where it's going. So it's absolutely critical, and the trade starts with it and ends with it. So you've got to factor it in. It's like 2/3 of the trade. Starts with the sweep, which is liquidity, and it ends with liquidity, as in you need a minimum of 1-to-1 before your next area of liquidity. So those are the rules that we stick to. Now, obviously, sometimes you might want to bend a rule. Say, for argument's sake, you have got equal lows below you, or you've got equal highs above you for a sell. That's entirely up to you. Now, I will bend the rules, but I've been trading for nearly 6 years, and I get away mostly with bending a rule here or there. We obviously stream live, so I'm very conscious that I really want the guys there to be independent and profitable. I don't want them to rely on me or Johnny or the group. So we teach it in a way that's very mechanical, and we've got very set rules. People are profitable using this. Our results speak for themselves. Let me just flip over here. What am I looking for? Results. These are our weekly results. Last week was atrocious. Very, very slow. Green week, 14 are up, bank holiday, well, Labour Day. But we are currently 359 are up for around 9 weeks. Each individual week is broken down trade by trade. We take them live in the streams. These are all called out and they're managed in the lives. We don't take anything off the live. If we do, it doesn't go on this list. So this is fully documented by video and members, real people that have left testimonials. So these are real numbers. So you can see it's profitable. If you want to look at a previous week, you can scroll up and you'll get a breakdown of exactly what trades were taken in that particular week. So if we look at this particular week here, which was week commencing the 29th of the 7th, you can see that we had an inverse there for 11R. We had another inverse there of 4. We lost an SB, which is a silver bullet. We won 2 inverses. We lost an inverse. I'm not going to go through it all. You can see it on the screen. That week alone was 48R returned. These were all of the trades, and they're all live. They're all taken. They're all called out before the event. They're managed on live on stream as well. So just to recap, fair value gap has to be 3 candles, 1, 2, 3. The gap between the wick of 1 and the wick of 3 is your fair value gap. The first thing you're looking for is a sweep of liquidity. That can be any liquidity that you wish. It can be an internal low. It could be a swing high. It could be a range high, or it could be a range low. As long as you've swept liquidity, that's all that matters. Do you have a single fair value gap? Now, in an ideal world, every trade would have a singular fair value gap. Sometimes you might get 2 on a leg. If that happens, what we wait for typically is the first one to be inversed, and then we treat the second one as its own trade. So if that then meets the rules and we've got a minimum of a 1-to-1, then we'll take the trade. In a perfect world, you'd only have 1, and it would be 1 minute, and it would be a perfect trade. Now, there is one thing also, just to touch on this, that makes these trades even better. Now, when you sweep liquidity, so if we were to sweep liquidity from here, but we also, during that process tapped into, say, a 3, 4, or 5 minute down here, that would then make that trade an A+ setup. So if we were to sweep liquidity and tap into a 5 minute, for argument's sake, that would give that trade extra clout. It would be elevated to an A+ setup. So that's something to bear in mind. And the last rule was the minimum of 1-to-1. Remember, the trade starts with liquidity and it ends with liquidity. So you've got to have a minimum of a 1-to-1 R. Now, hypothetically speaking, if we had a sweep here, let's just assume we have, just for the purpose of this video, if we've got a 1 minute bearish fair value gap there now. So we've got obvious targets above as well. We've got 2 sets of equal highs, which is really good. We've got no equal lows below us. Again, assume it's had a sweep. It hasn't, but assume it has. And assume it's tapped into a 5-minute. So if there had been some structure here, this would actually be an A+ setup. If we had a lower high here that had been swept, then, if we'd had a higher low here that had been swept, this would be an A+ setup. We would have had a sweep, a tap into a 5-minute. And as I'm saying it, another fair value gap pops up. But we're looking for these types of setups with a singular 1 minute. And then the final part of the puzzle is we need a 1-to-1. So when that candle closes above that fair value gap, that's where we would measure it from. You would just go below the fair value gap. Your next area of liquidity is that high there. That's a 1.24. So that would be a valid trade. Obviously, this was a hypothetical trade. It's not a valid trade. But if we had structure and we'd had a sweep, tapped into the 5 and obviously a single 1 minute, that would have been an A+ setup. So they're the rules that we use, the reasons why we enter trades, what a fair value gap is. If you're still unsure or you would like to know more, link in the bio to our Discord. We're streaming live every day with London and New York. We also do selected PM sessions. Both Johnny and I are profitable traders. We don't monetize the, we've got free sections, everything that people can get access to. We're even streaming 2 days a week completely free. We don't have, we're not, our business model isn't based around affiliate links or selling courses. Obviously, we've got courses, well, we've got mentorship and one-to-one sessions that we offer, but we are profitable traders and ourselves have been. Hopefully our numbers are testament to that. If it's something that you're interested in, pop over. It'd be really great to see you. Any questions, we've got a great community. DM me if it's something that you'd like to address with me personally. But thanks for watching, and if you have any questions at all, please ask, and I will be only happy to answer them. Thanks for watching.